weekend. Now I'm going to keep making videos for some of my friends who don't know much about trading, are interested, but don't know where to get started. And my friends that do know about trading, if there's anything I say that you disagree with or that's wrong, please challenge me in the comments. Maybe I can learn something as well. Alright, so we're clearly in this downward trend on a weekly time frame. Every candle represents a week of price action. And the theory is the trend is your friend. You trade with the trend. Now, there are weeks, multiple weeks of upward movements in this downtrend, which in this case, if you go down to a lower time frame, there was like a 4-hour uptrend, which meant longs were most probable during the uptrend. This particular candle here since last Sunday is abnormal. I mean, it's happened before, 17%. Similar percentage decline. So it's abnormal in the long-term trend. Usually they're not that big. But how would have we made money off last week's price action? Let's go down to a lower time frame. Okay, so that period of upward movement where you can make, well, it's highly probable to long, that's this here. And it clearly changed, double top, and it clearly changed to lower highs, lower lows. From a 1-hour perspective, so there's tools like Fibonacci. Just last night, you could have went, right, I'll draw my Fibonacci tool from the swing high to the swing low. Oh, look, it's hit the 0.618. Doesn't that seem manipulated? They've just driven the price to the 0.618. Let's put a short in. We'll put the stop loss above the 0.786. 2 to 1. Risk $100, make $200. As you scale your account, risk 500, make 1,000. Risk 1,000, make 2,000. But obviously you want to risk an amount of your account that isn't going to affect your psychology for the next trade. You want to make sure you have the stop loss, because if you're wrong, and it does break up here, it's changed market structure, there's potential for it to go a lot higher. That's why you need to be able to stop when you're wrong. And you can go all the way through and use technical analysis principles and say, right, there's a sort of a wedge pattern in a downward price action movement. The probability of it going lower from this pattern is high. It's higher than it breaking out to the upside, that's for sure. And once it did break down, it tried to go back up. They really tried to do it. You could have watched that price action, the weakness, and went, right, just here, we'll stop it out if it goes above. And look at that, 3 units of profit to 1 unit of risk. So because the price action's been so hectically down, it's been really easy to short. Where's some more? So similar to this, you can even go down to a 30-minute candle to get a more precise Fibonacci setup. So Fibonacci at the top of the price action to the bottom. Oh, look at that. It come into the golden pocket and consolidated, which then you could do a risk profile. Even if you did it at the 0.618, you got in too early. Just above the 0.786. Wow, that's huge. 1 unit of risk to 7 units of profit. So this is the key function, the risk profile, when you're setting up a trade. There's other things you can use to determine if it is going to decline from the potential pullback zone. So on the 30-minute, when it did come to this point, we could go down to a 15. Okay, there wasn't any RSI indication. We had equal highs, but we also had equal highs on momentum. But you can just ape. You can just say, right, it's a downtrend and ape, and I'll play the probabilities. If I get stopped out, at least in the long run, I'm going to make more units of profit than I am of risk. Have a good weekend, and if this kind of analysis interests you, personal message me, and I'll be able to give you more resources to study, and you can even practice this without risking any money.